On October 9th, 2025, a routine data release from the CME Group revealed something most investors never noticed. Less than 30% of all silver registered on the COMEX was actually deliverable. And one institution controlled nearly half of it. That institution was JPMorgan Chase. There was no headline, no press conference, no market alert. But buried inside those numbers was a reality Wall Street never explains. Silver prices don't move when supply disappears. They move after control breaks. And tonight, you're going to see how JPMorgan quietly positioned itself on both sides of the silver market, and why that strategy only ends one way, with a price shock. In September 2020, JPMorgan Chase agreed to pay $920 million to U.S. regulators. It was the largest penalty in history for precious metals manipulation. The charges were not rumors. They were not theories. They were criminal admissions. Between 2008 and 2016, JPMorgan traders engaged in spoofing, placing massive fake orders in gold and silver futures to move prices before canceling them. The U.S. Department of Justice called it widespread, systemic, and coordinated. 3 JPMorgan traders were criminally charged. 2 went to prison. This matters for one reason. Banks do not pay nearly $1 billion for behavior they abandon. They evolve it. Retention suspension. And the real question isn't what JPMorgan did. It's what they learned from getting caught. To understand JPMorgan's strategy, you must first understand a lie baked into the silver market. Silver is priced almost entirely through paper contracts, COMEX futures, options, ETFs like SLV. But here's the hidden structure. For every 1 ounce of physical silver, there are 100 plus ounces of paper claims. This isn't accidental. It allows price suppression through leverage, liquidity without delivery, control without ownership. And JPMorgan didn't just trade this system, they became its custodian. JPMorgan is a dominant COMEX clearing member, the custodian of the SLV ETF, a primary holder of registered silver inventory. That means they see flows, redemptions, stress points, delivery failures before anyone else. Retention suspension. When one institution sees both the claims and the metal, price becomes optional. Here's where the strategy turns surgical. Between 2011 and 2016, JPMorgan accumulated an estimated 700 million ounces of physical silver, quietly, relentlessly, during price weakness. At the same time, the bank maintained large short positions in silver futures. To the public, it looked like bearish positioning. In reality, it was price management. Suppress price, accumulate metal control paper, own physical weight. This dual position gave JPMorgan something unprecedented. The ability to profit whether silver fell or broke upward violently. Retention suspension. And this only works until too many people demand delivery. The COMEX operates on a fragile assumption that most contracts will never ask for metal. But when registered inventory falls below critical thresholds, confidence cracks. Recent data shows registered silver inventories have declined sharply since 2021. Deliverable supply is shrinking faster than total inventory. Industrial demand continues rising, and JPMorgan controls a disproportionate share of what remains deliverable. This is not conspiracy, it's arithmetic. When too many claims chase too little metal, one of 2 things happens. 1. Cash settlement. 2. Price repricing. Both destroy confidence. Mid-video cliffhanger. And now, the industrial side of silver is accelerating at the worst possible moment. At exactly the wrong moment, silver demand began shifting away from investors and toward systems that cannot function without it. By 2021, silver officially crossed a historic threshold. For the first time, over 50% of annual silver demand became industrial. Solar panels, electric vehicles, military electronics, 5G infrastructure, medical technology. According to data from the Silver Institute, photovoltaic solar demand alone rose from 51 million ounces in 2014 to over 160 million ounces by 2023. That's a 213% increase. And here's the critical difference. Investors can sell, factories cannot. A solar manufacturer does not hedge ideology. It hedges survival. JPMorgan can manage paper markets, but they cannot negotiate with physics. The most dangerous myth in silver is this: if price rises, miners will just produce more. That is false. Over 70% of silver is mined as a byproduct, primarily from copper, lead, zinc mining. This means silver supply does not respond to silver prices. It responds to global base metal demand. Even worse, new silver mines take 10-15 years to develop. Ore grades are declining. Energy and labor costs are rising. Global silver production has been flat to declining since 2016. Demand is rising, supply is rigid, inventories are shrinking. This is the exact setup that breaks paper pricing systems. Retention suspension, and JPMorgan knows this, which is why their strategy changes after this point. Here's the part most commentators miss. JPMorgan doesn't need silver prices to stay low forever. They only need time, position, optionality. Once physical dominance is secured, price suppression becomes irrelevant, because when the market breaks, the entity with metal controls terms, not prices. History confirms this pattern. Hunt Brothers, 1970s. Too much leverage, no system control. Nickel LME crisis, 2022. Shorts trapped, exchange froze trading. Gold revaluation, 1934. Government reset price overnight. Silver will not explode gradually. It will reprice administratively or violently, and JPMorgan is positioned for both outcomes. The real shock isn't the price. It's how fast the rules change when delivery fails. When silver breaks, it will not start with headlines, it will start with procedures. Extended delivery times, increased cash settlements, rising premiums disconnected from spot price, sudden rule updates by exchanges. We've already seen early signals. American Silver Eagle shortages, premiums exceeding 40-60% over spot, delayed ETF redemptions, registered inventory drawdowns. The public sees scarcity, institutions see stress, and JPMorgan sees the exact moment when paper confidence disappears. Because when trust breaks, price no longer needs permission. Here is how the silver price shock unfolds. Structurally, not emotionally. 1. Industrial demand continues rising. 2. Registered inventories fall below critical thresholds. 3. Delivery requests increase. 4. Cash settlement replaces physical delivery. 5. Spot price loses credibility. 6. Physical price decouples violently. 7. A new reference price emerges. At that point, silver does not moon, it resets. And JPMorgan's physical holdings become vastly more valuable, not because they predicted collapse, but because they planned for inevitability. Empires don't collapse loudly. They collapse when systems stop pretending. Silver is not about wealth, it is about truth in pricing. When paper promises exceed reality long enough, someone pays the difference. And history shows, it is never the institution that prepared quietly. It is the public that trusted stability. If the silver market reprices overnight, will you understand why? Or be told after it happens? Comment, Silver Reset, if you see what's coming, and subscribe to Empire of Secrets, because the next investigation reveals what happens when gold and silver are no longer priced by markets, but by